Hello, my name is Grant Joyner. I am the founder of Vineyard Wealth Group. I'm a certified financial planner professional and an enrolled agent. And today we're going to be talking about the cost of doing nothing, which is really inflation. Right now, with all of the economic uncertainty, the political uncertainty, there's a lot of people that I talk to that just say, I don't want to make any big picture changes until things settle down. And the newsflash is that things rarely feel settled, and one of the most dangerous things that you can do is say this time is different and think that you're able to outsmart the market in the economy. So we're going to be talking about the inflationary environment that we're in, which is very real, the cost of doing nothing, and what you can do to fight against inflation, even if you're not going to take on a lot of risk. So let's jump into it. So the cost of doing nothing, how inflation quietly erodes purchasing power, and what you can do about it. So we're going to talk about inflation as a retirement risk. I always do a 5-factor risk assessment for any retirement plan that I run. It's WILMA, withdrawal rate, which is your spending, inflation, longevity, medical, and asset allocation. And we'll be hitting on a lot of those topics today, but inflation is a real retirement risk. The hidden cost of holding cash, how you can put your cash to work even if you're not taking on risk, how you can build a retirement cash bridge that can help you bridge across a bad economy or a bad stock market, and why long-term growth still matters regardless of what's going on in the broader market. When there's inflation, growth matters. Okay, so let's look at the purchasing power of portfolios and inflation quietly eroding this, right? So what we have here is $100,000. That's staying flat because that's the amount of cash that we have. And you can see in the green is the purchasing power, and the gold is sort of the loss of purchasing power. And over 10 years, 15, 20, 25, 30 years, this is quietly eroding the purchasing power. $100,000 today is not $100,000 30 years ago. And I think all of us have seen that. We've seen it more pronounced in the recent terms with COVID and what happened with the big spike in inflation, and we're starting to see inflation tick back up. It's not every 5 years though. This is a linear sort of path, right? And this chart shows this, that over the span of 30 years, if you have a 3% inflation over 30 years, the sort of loss of purchasing power over time. So what can you do to fight this? Obviously, you can look for growth, but even if you're not going to look for growth, there are opportunities for your cash to be doing more for you. There's a tendency, especially here on the island, for people to hold lots of cash. Some people just hold physical cash. Many others are holding cash in checking and savings accounts at banks. And those accounts typically are not earning a whole lot. And right now we have inflation running at about 3.5% to 4%. Checking accounts are typically earning nothing. Savings account maybe 1 or 2%. And if you want to get more than that, you got to get a CD, and it's going to be a 3-month, 6-month, 9-month CD, and then you got to repeat it. You have 10 days to take the money out. There's early withdrawal penalties. Basically, it puts the onus on you as the consumer to get a fair rate of interest from your bank. So what can you do to balance that out, right? Well, one of the ways that you can do this, instead of holding lots of cash at a bank, if you utilize investment accounts and investment instruments, you can get a fair rate of interest more easily over time. One of the easiest ways to do this is with money market mutual funds. Not money market accounts at banks, which aren't real money markets, but money market mutual funds, which is just a collection of very, very short-term debt. $1 equals 1 share. You're not really worried about principal risk. There's some hypothetical principal risk that I'm not going to get into today, but very, very unlikely of principal loss. What happens is the interest rate will fluctuate. So as rates go up, these things pay more. As rates go down, they pay less. But these are great instruments when you're in a rising interest rate environment, which it does appear that we are right now. Another way to guarantee your rates is through treasury bonds. You can buy secondary market treasury bonds, ones that already exist, or go directly to auction to get basically the current interest rate that the US government is offering, which is going to be in line with the short-term rate curve. And then brokered CDs. So rather than going to your bank or 2 or 3 banks on the island to see what the best rate is, when you buy a CD through an investment firm, you can have hundreds or thousands of banks competing for your money, which means that the rates go up because there's more competition. There's more supply, which makes the rates typically go up. So oftentimes I talk to people, even if you're going to do CDs, it's easier to do them through a brokerage account and you're going to make more money. And then finally, there are Treasury inflation protected securities, which are issued by the government. They're like Treasury bonds. You're really not trying to get any sort of growth. What you're trying to do is just make sure that you don't lose ground. It's a great way to not lose any ground because they're benchmarked against inflationary metrics, right? So that if inflation goes up to 5, 6, 7, 8, 9%, if it goes crazy, you're going to have protection against that because these are built to fight against inflation. So these are some of the options, what you can do with cash, even if you're not looking to take on more risk, things that you can do for your cash to make sure that you're at least treading water and not losing ground over time, right? But one of the things that we talk about for people that do hold a lot of cash, is it the right amount of cash? And this is really dictated by your financial plan and how much you need from your portfolio. Let's talk about a hypothetical example where you need to spend $100,000 a year, and between Social Security, pension, and rental income, you're getting $60,000. Okay? There's a $40,000 gap in what you need. So rather than sort of guessing about how much cash and how much risk you should take on, we use a systematized approach. We're going to say we want 1 year of that $40,000 gap in liquid interest-bearing accounts. And that would be a great spot for a money market fund. Completely liquid, you can get in and out in 1 day. And we then have the next year of our expenses completely accounted for. Then when we go out to 2 to 3 years, we're looking at treasuries, we're looking at brokered CDs. And again, what we're doing is we're building a bridge against a potential negative market and economic environment. So in a case like this, if we were to build a bridge, we now have 3 years. The next 3 years, we have guaranteed income. We know exactly where we're getting the money from between what we need to get from our portfolio and what we need to get from our guaranteed income sources. We know exactly where it's coming from. Beyond that, we could build a longer bridge with intermediate term fixed income. And then once we get past 5 to 6 years, that's where we're looking for the real long-term growth potential, because there is a tendency early in retirement for folks that are 60, 65 to say, listen, I don't have as much time. I want to take risk off the table. I want to be more conservative. And that's very logical, and it often makes a lot of sense. But what you have to count for is even at age 60 or 65, we still need to plan for 10, 15, 20, 25 years. And if you rewind 25 years ago, things were just way cheaper back then. So you do need to have something that is going to grow for you in the long term. So let's visualize what that growth looks like over time. The cash and the gold here, if it's not treading water, if it's not using something, losing its purchasing power, versus the green, and this is assuming a hypothetical 7% rate of return, which would be sort of indicative historically of a balanced 60-40 portfolio. Past performance is no guarantee of future results. There's nothing guaranteed in that regard. But again, the idea would be that if you build a cash bridge, and we go back to 2007 and 2008, 2009, the global financial crisis, which was the worst economic and market downturn since World War II. I started in the industry in 2006 and started at Charles Schwab, where I worked for close to 14 years in 2007. And that was a really tough time for a lot of people, and it felt like an eternity. But the reality is, for the stock market itself, it was 37 months between the top to the bottom, back to the top. So if you had a 3 to 4 year cash bridge, you didn't have to sell any of your long-term growth assets, and you would allow them to stay invested. But if you did not have a plan that accounted for that early downturn, then you would have to sell things at a steep discount, and you may never recover. So these decisions really cannot be made in a vacuum. It is part of the retirement planning process to figure out exactly how much you need from your portfolio, and then subsequently how you should structure how much cash you hold, where you hold it, and making sure that you have a plan for inflationary environments, for great environments in the market, for bad environments in the market. And whether you are a client of ours or not, we offer complimentary consultations to put together financial plans and retirement plans where we go through that Wilma analysis, we go through figuring out how much you need from your portfolio, and it's completely free, complimentary. We subscribe to the idea of giving value before asking anything in return. My email's on here, as is our phone number. We're at 5 Beach Street, which is the old Sports Haven location. You can go to our website, book the meeting directly. But regardless of your circumstance, we're happy to put together a plan if you don't have one. If you do have a plan, hopefully this presentation helped you get an idea of how you can structure your cash to make sure at the very least you're treading water and that you figure out how much you should have tilted towards growth. We appreciate you watching this video. We hope that you like it. We hope that you subscribe to this YouTube channel, share it with a friend. We also have an Instagram. Thank you for watching, and we'll see you again soon.